Okay, so if you've been watching the financial markets lately, you've definitely seen it. An absolute sea of red hitting some of the most popular, high-flying stocks out there right now. Today, we're jumping right into a massive market mystery for this explainer, the sudden and honestly dramatic sell-off we're seeing in major tech and semiconductor stocks. We are going to break down exactly what's happening, the somewhat hidden catalyst driving this drop, and where all that institutional money is actually flowing while tech bleeds. We're talking about the NASDAQ taking a hit of almost 2.5%. That's a near 650-point decline. And it's not just some broad, vague pullback. This heavy pressure is squarely hitting the absolute giants of the chip space. We're talking names like Micron, AMD, Intel, and Broadcom. These are the exact companies that have essentially been carrying the entire market on their backs. And suddenly, they're facing this intense, real-time pressure across the board. Which brings us to the core mystery of today's explainer. Why exactly are these tech giants stumbling when their earnings are actually strong? Did Broadcom really spook the market that badly? Well, here's the fascinating part. Broadcom basically met its numbers. The miss on their report was incredibly minor. In fact, they projected demand being strong not just this year, but all the way through 2027. Yet, the market still reacted with a violent sell-off. So what gives? Well, to understand the fall, you really have to understand the unprecedented climb that set the stage for all of this in the first place. Section 1. The Chip Stock Rocket Ride. Before this sudden drop, the sheer scale of momentum was just staggering. When companies like Micron, Dell, and HPE reported their earnings prior to Broadcom, the charts went straight up and to the right. We're talking massive 20, 30, even 30+% instantaneous jumps in a single day. Broadcom just had the sheer misfortune of being the last in line to report in this cycle. When you're the last one standing after a string of rocket ship moves from your peers, expectations become literally impossible to beat. Just think about these gains from their March lows. AMD was up 150%, Intel up 152%, and Micron up a staggering 188%. And year-to-date, they're up even more. These numbers are meteoric. When stocks fly this high, this fast, a pullback isn't just a possibility. It becomes almost a mathematical certainty as traders eventually look to lock in their gains. So we know these stocks were priced to perfection, but what was the actual match that lit the fuse for this specific sell-off? Section 2. Cashing out for SpaceX. To really grasp this, we need to talk about dry powder. Right now, retail and institutional investors alike are actively looking for ways to raise cash. And where do you get cash when you need it? You sell your biggest, most profitable winners.
And what exactly are they raising all this dry powder for? The highly anticipated SpaceX IPO hitting the market next week. We haven't seen a massive cycle of high-profile initial public offerings in a long time. Investors are standing on the precipice of this SpaceX event, and they want in. To get in, they're willingly clearing out portions of their massive tech and chip portfolios to build up that capital.
The absolutely crucial point here is the psychology of it all. The prevailing sentiment across the market right now is basically, I don't want to be the one who turns out the lights, right? Everyone knows these chip companies have great outlooks for the next year or two, but after a 180% run, investors start looking at the end of the cycle. Nobody wants to be the last one holding the bag when the momentum finally stops. They aren't necessarily liquidating their entire portfolios, but they are absolutely taking a healthy chunk of profits off the table. So how are traders actually navigating this volatile drop in real time? Because it's definitely not just a blind panic.
Section 3. Testing technical support levels.
Let's walk through a real-world example of a trader actually trying to buy this dip. It's a very calculated process. You identify the historical support, execute a pre-market trade, and crucially, you have to set a tight stop loss. In the example from our source, a trader bought in, assuming the bleeding had finally stopped. But actually, scratch that. The stock dropped another 6% almost immediately. That stop loss was the only thing that saved them from a highly volatile, punishing event.
This is exactly why knowing where the floor is matters so much. Analysts are keeping a very close eye on massive technical support levels, specifically that 3.55 to 3.60 range. Major institutional holders, some of whom have a massive 4% weighting in these names, are watching these precise numbers like hawks. Until the market stabilizes at these major technical floors, many of the big players are perfectly content to just sit on their hands and do nothing. Which brings up a fascinating dynamic. If all this money is flowing out of tech and stopping out of semiconductor trades, it hasn't just evaporated into thin air. Where is it actually going?
Section 4. The Great Sector Rotation.
We are basically witnessing a tale of two completely different markets right now.
Tech screens are flashing a painful, deep red, while defensive screens are lit up bright green. High-flying momentum stocks are crashing, but traditional safety plays, we're talking companies like Clorox, Kimberly-Clark, Pfizer, Bristol-Myers, and Realty Income, are actually seeing really solid gains.
Institutions aren't just moving to cash and hiding under the mattress. They're actively reallocating. The new playbook is pretty clear. Trim your heavy tech exposure and rotate those funds into safer, more reliable harbors. We're seeing major players actively buying into healthcare giants like Eli Lilly, massive financials like JP Morgan, and diversified conglomerates like Berkshire. It's a calculated defensive move to prepare for exactly this kind of volatility.
And adding fuel to this fire is the broader macroeconomic picture. Those strong non-farm payroll numbers we saw, they're actively exacerbating the downside in tech. Why? Because when you have strong jobs reports, the market immediately starts adjusting its expectations on interest rates. Suddenly, people aren't just worried about rate cuts being delayed, they start pricing in the wild possibility of rate hikes. And when interest rates are perceived to be going up, well, that has a direct negative impact on high-growth equities like tech, which just speeds up this great rotation.
But hey, let's look at the silver lining for the patient, prepared investor. As the old Wall Street saying goes, almost all the alpha is generated in the terrible, distressed moments. Alpha isn't usually made during the quiet, boring stretches. It's made during what some analysts call a liberation day, a moment of panic where you finally have the cash on hand to step in and buy incredible cash flow generating giants like Apple or Google at a steep discount, simply because everyone else is panic selling. What we're ultimately witnessing here is the brutal reality of a purely momentum-driven market. Just think about this. Despite a long string of companies reporting great quarters, raising their forward guidance, and seeing their price targets hiked across the board, it literally only took one perceived underperformer, Broadcom simply meeting expectations instead of completely shattering them, to drag down the entire sector. The momentum shifted, and the dominoes immediately fell.
So that leaves us with the million-dollar question. Is this the beginning of the end for tech's historic run, or is it the ultimate opportunity to finally buy the dip? Are retail investors going to jump right back in after the SpaceX IPO dust settles, or has this great sector rotation permanently shifted the landscape? It's a high-stakes puzzle right now, and understanding the mechanics behind these drops is really the only way to successfully navigate what comes next. Thanks for hanging out with me for this explainer. Keep a super close eye on those support levels, and we will see you next time.